Hey everybody, hope everyone's doing well and had a good day. This is the Emini end of day review for Monday, July 29th, 2024. And because it's Monday, we'll go ahead and look at the weekly chart first. In the weekly chart, what the bears did the past couple of weeks is important. The bears have created, that's the wrong one. In this last rally, the bears have a trendline break. So we have a tight bull channel and then a pretty strong trendline break. And so what we have setting up here, last week, this bar is last week's bar. This is a high one signal bar, but we have consecutive bear bars breaking a pretty strong bull trend line. So the odds are there's sellers above this high one if we rally up there. Now this channel was tight enough that we'll probably not just sell straight off. We might need some sort of major trend reversal. So a test of the highs, whether it's a lower high, higher high. We're probably going to come back and test these higher prices before we go sideways, or in fact get a major trend reversal into a bear trend. And then coming into the day, what we had on the daily chart, two legs down for the bears, but this entire two-legged move is strong enough to be a single breakout on a higher time frame. And so we have this bull bar, but it's most likely due to bears taking profits rather than aggressive bulls buying. But it's a bad sell signal bar, and it's two legs down, probably buyers below the bar. So coming into the day, most likely, the market was most likely to go sideways to up. You'll have less bears willing to sell down here, especially after this bar. Bears who sold this follow-through bar, bear breakout, follow-through, they're disappointed by the rally. And so on any retest, these bears who sold down here, they scale in higher. They're looking to get out, break even on their first trade down here. So that creates support. We'll probably have to go a little bit higher, maybe test the moving average. But this is a bad buy setup. So buying above last week, Friday's high, this bar, the bull bar, not a very good buy setup. You can see there's sellers into the close, so not a very strong signal bar. If this was a strong buy setup and the bulls had strong momentum, why were there sellers into the close? That doesn't make sense. However, it's two legs down, so you can argue it's a big high two, high one here, high two. But the reality is this is too steep. There's probably sellers above for at least a small second leg. And then coming into today, here in Friday, the market was in a very tight trading range. Now we have a gap up to bar one, but then bar one immediately rejected the gap up. We have a bear trend bar. It could be two legs up on 78, pause, sideways, and then another rally on the gap up. But the context for buying up here, not very good. Not very good for a couple of reasons. It might be high in this trading range. You can see the gap up, attempting to break out of this trading range to 57 or 52 high on Friday, but it immediately failed. There was no follow through. So if we get back up to the open of the day, you have disappointed bulls buying here. They'll be disappointed by the sell-off on bar one, and now we might be high in a trading range. The market also could be in an expanding triangle. We're getting higher highs, lower lows, and so buying up here is not ideal. This is more of an area to look to sell. Plus what I said earlier, on the daily chart, there's probably sellers above yesterday's high. So the upside, we may go a little higher, but the upside is likely limited. Bar one is strong enough, you would expect at least a small second leg, and probably sellers above bar one. But as far as selling below bar 1, not really ideal, kind of in the middle of this trading range. So selling on stop orders here, not the best. Bears would rather sell higher up. And then bar 2, we traded below bar 1, but then reversed up. We have a trend bar. But bar 2 rather, is a high 1 buy after 2 legs up, high in a possible expanding triangle or trading range, however you look at it. So probably not the best area to look to buy. There's probably sellers above 2, but maybe not directly above, because bears selling on limit orders would prefer to sell above a bear bar. We're probably getting above bar 1, so bears may wait to sell above bar 1. And then 3, we remained inside bar 1, but bar 3 broke out above bar 2. Bar 2, even though it's a trend bar, it's not a bull breakout bar. It did not break out of the high of the prior bar. So bar 3 is a breakout bar, breaking out of the prior bar, bar 2's high, but it's a small breakout. And again, it's still inside the range of bar 1. So the first 3 bars here are overlapping. And that's trading range price action, trading range behavior. So probably sellers above 3. Probably buyers below 3. It's a bad signal bar for stop order bears. Bull reversal bar, also location, isn't great. 4, we rallied a little higher. We got a higher high above bar 1, but there were sellers above bar 1. Now bar 4, we have a second reversal. We tried to reverse below bar 1, and now we have a second reversal setting up on bar 4. So you might have some traders selling below 4, betting it's a higher high with bar 1, double top. But bar 4 is a weak signal bar. It's a trading range bar. And the rally on bars 2 and 3, probably strong enough to disappoint bears below. Remember, bears on bar 1, expecting a second leg down, but they're getting a deep pullback. So you have disappointed bears below. Plus you have bulls who missed this rally. So probably buyers below 4 for at least a small second leg to the upside. And then 5, we sold off below bar 3. Pretty deep pullback, but then we rallied into the close. So we closed above the midpoint. Bar 5 is a bull bar, even though it has a bear body. Now we have a high 2 above bar 5. Double bottom with bar 2, but a weak signal bar. Probably sellers above, but the sellers may not come in until above bar 4. We still have yesterday's high, the magnet above. We could easily go for a measured move of the opening range at this point. Maybe not that. Maybe bar 1, we rally up to here. But this is a bad buy signal bar. Probably sellers above here as well, scaling in higher, betting the market's overall in a trading range from Friday into today. So sellers above, scaling in. 6, we rallied. It's a strong looking bull bar, a really good looking bull bar, but the context, not ideal. A couple of ways you can see this as 3 pushes up. Maybe rally on 72, pulled back, rally on the gap up, bar 1, pulled back, and then rally up to 6. Or even right here, 1, 4, and 6. So a couple of ways to see consecutive buy climaxes here. Still within the range of the expanding triangle. So probably limited upside. Even though 6 is a good looking bar, still needs follow through. And even if it gets it, if it doesn't break strongly above yesterday's high, we're probably still within a trading range. This was a strong bear breakout, spike in channel bear trend. Eventually we'll convert into a trading range, which we have, but now we have sellers up here. Think about if you're a bull and you bought the close of bar 48 on Friday, or bought below the bar, betting it's a weak sell signal bar, and then you got trapped. If you're able to get out at break even all the way back up here, you're going to take that chance. And then you consider the price action going up to that price. The market's not rallying like this in sort of a small pullback trend kind of way. It's very choppy with deep pullbacks, consecutive buy climaxes. So probably limited upside here, as strong as bar 6 looks. Probably sellers above, maybe at a distance above, maybe half the distance of a measured move. That's the wrong one. That's the problem. Just had it drawn the wrong way, so we want the negative 50. So if we take a measured move of bar 6, somewhere up here, that's actually this darker line, maybe we'll get to the purple line, but we're not expecting a successful breakout and follow through measured move of bar 6, considering the context and the price action. 7, we got follow through, but the context is still bad. So even though we have a breakout and follow through, you have to ask yourself, is the market in a trend or is it in a trading range? And it's pretty clear the market is in a trading range. We have price action, a couple of legs down, a couple of legs up, lots of overlapping bars. In a trend, you get higher highs, higher lows, and a bull trend. But here, we're still at a lower high. So we don't know how many sellers are above yesterday's high. So bull breakout and follow through. But it could just be a buy vacuum test of resistance. I mentioned the low of bar 48. And that could be an area where traders start to take profits, where bulls who bought here and scaled in lower are looking to avoid a loss. So probably sellers in this area, kind of dangerous to be long. 3 pushes up at resistance. And then a strong bear trend bar on bar 8. So bar 8, if we think in terms of always in, even though in trading ranges, I typically think more buy low, sell high, and always in is kind of reserved for swing trading and trending markets. It's still useful in a trading range like this where the swings are pretty wide. And you can see we've had maybe 3 legs up, maybe here, 1, 2, 3, 3 or 4 pushes up, overall high in the range. We had a reversal attempt below bar 1, again below 4, and now we are reversing below 7 with a strong bar 8. So bar 8's a low 3. It's a nested wedge, a couple of different ways to draw the wedge. Strong signal bar, good context, possible double top, high in the range. So bar 8 is an always in flip. And so what I mean by that is you'll have traders, bulls who bought, if they didn't take that chance to exit at the low of bar 48, somewhere in bar 7, they see bar 8, they gotta just get out below it. Bears see a bar like bar 8 and they recognize what's happening. We're getting a retest of an area where bulls got trapped. We're high in a trading range. The expectation is a couple of legs up and then a reversal and then a test to the bottom of the range. So you get a bar like bar 8. Bears will sell below bar 8 as well. So the market might be always in short at this point. And then 9 only confirms that. So now we have a pair of strong bear bars, 8 and 9, crossing the moving average, both closing near their lows, 9 closing below the moving average. Very little overlap. Look at the pullback on bar 9. There's hardly a tail. Might be a 1-tick upper tail. So if any trader tried to buy here, betting strong enough, 6 and 7, for a second leg up, they just immediately got trapped with no chance to exit. So this is a pretty good looking bear breakout. I would consider bars 8 and 9 a major leg 1 breakout. And whenever you get a major leg 1s in general, but especially like this, it's similar to this. You're expecting a second leg down. Now, 80% of breakouts pull back before the second leg starts. So you can wait for a pullback to enter. But when the market's selling off like this, and it's strong and the context is good, the most important thing is to just get short. So it's okay if you sell the close of 9 and there's a deep pullback because you're probably Going to get a second leg down, you can always scale in on the pullback. Sell small, don't sell a full position. Just maybe sell a half-size position, scale in higher, and then look for, in this case, you could go for a measured move. The measured move of bars 8 and 9 is still within the range of this trading range, so that's not that unreasonable. It's a pretty reasonable thing to look for. Leg 1 breakout, measured move isn't requiring a major breakout down here, so that's a reasonable target. 10, we're getting a pause bar. The market's pulling back. We're testing some resistance, so let's think about bars 8 and 9. First of all, bar 7 was a weak signal bar. Then we got a strong entry bar for the bears, and then follow through. So the low of bar 7 will be resistance. The low of bar 6 will be resistance. Even here, these are breakout points. The market broke out below the low of this bar, the low of bar 6, bar 5. These are breakout points. The market often tests breakout points, but in a strong breakout like this, we'll probably test the bar 6 low. It's pretty close to the current close. However, the bar 7 close is more out of reach. If you're a bull and you bought below bar 7, you're pretty desperate to exit on any little bounce. So we can see bar 10 rallied a little bit above the low of bar 6, sold off into the close. Pretty weak reversal attempt. It's a high one. There's really not even an implied high one in here. This is just a breakout. First reversal attempt, smaller bull bar, selling into the close, probably sellers above 10, betting on a second leg down. 11, we rallied a little further. We tested the low of bar 8. We're getting closer to the low of bar 7. We're at a price where if a bull bought below bar 7 and bought more, you could argue maybe below bar 5, below bar 6. They bought somewhere down here. They scaled in. They're getting around their average entry price on bar 11, and they might just take break even on the entire trade rather than trying to get all the way back up to their original entry, whether it's the low of the bar, the close of the bar. Bulls are pretty desperate to get out. Then you have bears. Again, this is a major leg 1 breakout. So you have both bulls and bears fairly desperately looking to sell a pullback for that second leg. Strong enough rally. There's probably sellers, probably buyers below bar 11. Not a very good signal bar for stop order short. This might get a small second leg, but this is a minor leg 1. So we have a major leg 1, minor leg 1. So let me see if I can briefly find an example. I know we had some good ones on this bear trend day. So like right here, market's selling off, tight channel, it's a breakout on a higher time frame. Even just right here, 5 consecutive bear bars. Then we get 2 bull bars. The odds are there's buyers below 25, but this is a minor leg 1 after a major leg 1. So this is obviously stronger. The market's always in short. Better to look to short, but you will have bulls buying below 25 for a scalp, for a quick second leg. And that's the second leg they got. It's very minor. And then the market continued lower. Same thing here. Decent looking bull breakout, but look at the context. Maybe it's a leg 1. You could even argue this is leg 1, this is leg 2. So even if this is leg 1, strong enough for a second leg, but it's a minor leg 1. So the second leg could be very brief. But then this one, of course, strong enough for buyers below, second leg. The bulls got it, and then we continued lower. So that second leg could be really minor when the context is always in short. $12, we had a bear bar falling below 11. Now we have a sort of a tight trading range with the past 3 or 4 bars. Probably buyers below 11, but if you bought below 11 and 12 is your entry bar, it's fairly disappointing. We could still bounce. 10 and 11 were strong enough that they may get a second leg, and the bears might wait to sell a low 2. Bar 11 was the low 1 with a bad signal bar, so we may have to rally, maybe test the close of 11, maybe just get a small second leg. But the odds are we're still always in short. This is just a pullback before a second leg down. And in this case, we sold off on 13. So, one more thing just to recap what I was saying. This is very important. Bars 8 and 9 are a major leg 1 breakout. 10 and 11, minor leg 1 breakout. You can even see, I didn't even mention this, bar 10 rallied, sold off into the close. I did mention it was a weak bar with sellers into the close, bad stop order, and then we rallied again on 11, sellers into the close. So if you look at a smaller time frame chart, market rallied, pulled back, rallied, pulled back, that could already be 2 legs up. And we had sellers on the close of bar 11 on 12. And then follow through 13. This is a pretty tight bear channel. Still always in short, still room to the downside, the bottom of the trading range. So probably better to wait to buy a little bit lower, look for a better, more reliable buy setup. Bulls here can argue 3 pushes down, kind of similar to yesterday. 1, 2, 3. Buyers below. But of course here, context is a little bit different. Strong breakout, expecting a second leg. 12 and 13 strong enough for their own second leg as well. So probably going at least a little bit lower. 14, we pulled back. So we fell below bar 10. The bears wanted follow through. They didn't get it. They needed one more bar. They didn't get it. But 14, still not a very good buy setup because the context. Overall middle of a trading range. So maybe 50-50, but you're also buying against a tight bear channel. This is a breakout on a higher time frame chart. So the upside here is probably limited. You had bulls who bought below 11 get trapped. Maybe we'll test the low of bar 11 and then turn down. But as strong as bar 14 looks, it's fairly small. Plus, it's an inside bar. Breakouts of inside bars have reduced probability of success. They're trading range bars. It's an inside bar. You have a higher low, lower high. The market's contracting. So probably sellers above. But as far as buying below, if this was occurring down here, there's an argument for it. But because of the location, the context, in the middle of a trading range, probably not ideal to buy below with a tight bear channel. 15, we rallied. We did test the low of bar 11, but 15 is a small bar and it failed to break out. It attempted to break out above the high of bar 13, but then it sold off into the close. So consecutive bull bars, 15, weak stop order, signal bar for the bears. There might be buyers below, but there might be buyers below for a small second leg. This could just be like this, a minor leg 1. So you might get a small rally, but the odds are we're still going a little bit lower. And then we went outside down, 16. So 16, the bulls will argue it's an outside bar, so it's an expanding triangle. It's 3 or 4 legs down. So again, maybe 1, 2, 3, 4. Double bottom, buyers below 14. There is a case for that buy. But with all these bear bars, the selling pressure is pretty good. This is still a fairly tight bear channel. And you would prefer the buying pressure to be a little bit stronger. When you think about, let's look at one thing here. This one's more subtle. This one up here is more obvious. If you think about gaps, you can see the lowest close here on bar 11 did not overlap or close above the open of bar 7. So we have an open gap. And the reason I'm looking at closes is because a lot of traders and institutions look at line charts. And the line chart plots the close of each bar. So if there's no overlap on the close, so for example here, the open of bar 11 15 did not rally and close above that, so we still have an open gap, even though this is what Al would call a negative gap or a body gap, where the prices overlapped. But on the line chart, we have now two open gaps, from here to here, and then from here to here. So it's subtle, but you'll notice there's two open gaps. And so if you're trying to buy a wedge, it's better to see gaps closing and better buying pressure. But what you'll notice about the bars I have here, since bar 8, a lot of the bear bars are closing on or near their lows, and a lot of the bull bars have selling into the close. So the selling pressure looks stronger. This looks like a wedge, but we could easily get a bear breakout of the wedge. And if we do, it's possibly fall for a measured move. However, this looks kind of out of reach because of the bar 78 low. This could be the trading range, probably buyers at this red line. But if this is a bear breakout of this wedge, this would be the target for the bears. 17, we have another bear bar. So if you think about, if you're a bull and you're looking to buy, 3 pushes down, maybe 4. You're hoping for a good signal bar, something like 14 or 6, a bull bar closing on its high, reversing bar 16. But instead, we're getting a small bear bar closing on its low. And that's not ideal. That's pretty disappointing. 16, 17, probably strong enough for sellers above 17 for a little bit more to the downside. So the bulls might step aside, and this is very common in trading ranges. And this is what leads to vacuum tests. It's less due to aggressive bears selling and more due to strong bulls stepping aside and setting limit orders to buy lower. You might have an imbalance here. Bulls, they don't want to buy a weak signal bar in the middle of the range. They want a good signal bar low in the range. 18, outside down, trading range bar. So in this case, we have the bulls and the bears not exactly getting what they want. It looks like a bear breakout, or it looks like a bear breakout attempt, but it's fairly weak. If you draw this channel line, bar 2 low, bar 13 low, we're hardly breaking out on bar 18, and we're not closing far below. And that's not good for the bears. But the flip side, we now have 3 consecutive bear bars, a couple of open gaps, not much for the bulls to buy either. Again, I think bulls probably stepping aside, waiting to buy lower. Bears, they can hold short, betting it's always in short. We're going to test lower in the range. But if there's a good signal bar for the bulls, they'll probably have to get out. 19, breaking out to the downside. Not a very strong breakout bar. Sell buyers into the close. But it's a weak stop order buy. There's probably sellers above the bar. Tight channel, overall tight bear channel. Probably going at least a little bit lower. And then 20, another bear bar. So we have 5 consecutive bear bars. Not a micro channel because 18 pulled back above 17, but still tight enough. Probably sellers above. Another bad stop order signal bar. We're getting a breakout of this channel line. And we retested it on 20, sold off. So we might have to go a little lower to find buyers. The buyers, they might come in on the close of 77. You think about the same logic as over here, but the flip side. Bears who sold the close of 77, maybe front running a breakout, got trapped on 78. So if the market gets back to that price, they got trapped all the way up here. Bears who scaled in or didn't, they get back to their original entry price. They'll be happy to buy back shorts there. The bulls know that. They know it's low in the range. The market rallied, selling off, probably going to rally again. So you probably have buyers in this area. 21, selling off, pulling back again. So if you look at a smaller time frame, this is probably consecutive sell climaxes, and it's not that clear. And the reason, a couple of ways you can recognize that. The market's channeling down, even though it's a micro channel since bar 18, no pullbacks. But these bars have a lot of overlap. 17 overlapped 16, 18 completely overlapped 17. These bars also have a lot of overlap, sold off on 21, rallied into the close. This looks like a channel, and then this is a bear breakout attempt of a bear channel line, which we know is low probability. Maybe the channel line's there. Easier to see it and draw it on a lower time frame, but we can infer it on this time frame. But now the problem we're facing for the bears, a couple of ways to look at this, as a bear breakout attempt of a bear channel line. This one's less good, but this one, 1, 2, 3 pushes down, and here 1, pause, 2, pause, 3, and then possibly a double bottom. This is an area for bulls to look to buy and for bears to look to buy back shorts. So we could easily bounce here at a minimum, if not reverse. So in general here, a little bit dangerous to be selling. Plus you can look at it as these 3 pushes. This one is the most sort of extended, has the most bars, but it's the weakest of the 3 with a lot of overlap. Spike and channel. At a minimum, we're probably going to come back and test the high of bar 18. And speaking of that, I'll touch on that again. Actually, I'll touch on it first. Spike and channel. So here's a spike, 16, 17. We pulled back, 18 went above 17, and then we channeled. As I said, these bars have overlap, tails. This is a channel on a smaller time frame. The expectation after a spike and channel is not another bear breakout. The expectation is the market converts into a trading range and tests the start of the channel, which in this case, the high of bar 18. Spike, pullback, channel, expectation, we test here and then see what happens next. What I found really interesting the other day, was it here? It was this day actually, it was Friday. Here's a big spike and channel, big bear spike, pullback, channel. Obviously it converted into a trading range. Actually, let me draw it this way. So here's our spike and channel. Spike, pullback, bear channel. What's really interesting is there's a nested spike and channel within the spike and channel. So if you look in here, bars 57, 58, that's a spike. We pulled back, bar 60, and we channeled down. It's tighter, it's smaller. But it is there. And I'm bringing this up for a reason. So here it is, bear spike, pullback, channel. And then look at bar 72. If 60 was the start of the channel, the expectation after a spike and channel, spike, pullback, channel, the expectation is not a bear breakout and then a stronger bear trend. The expectation is the channel converts into a trading range. That's the market cycle. In this case, the high of bar 60 was the start of the channel, and you can see what happened. The market rallied up to the bar 60 high on bar 72 in a buy climax, consecutive buy climaxes, and then immediately found resistance in this case. So I just found that interesting. And that's why I think at a minimum today, we're probably going to come back and test the high of bar 18 because it's a spike and channel low in a trading range. So even though 21 is a bear close, it's a buy signal bar, so it's a minimum buy reversal bar. And even though it's a 4-bar micro channel, it's 3 pushes down, possible double bottom, buying above 21 is not the world's craziest stop order buy. It's not great. It's better to wait for a second reversal, a good signal bar, but there are valid reasons to buy in this area. 22 remained an inside bar. We did not trigger the buy, but now we have an inside bar at support with the context, 3 pushes down, the price action also supporting the fact that this area is likely to be support. So with an inside bar, especially the downside breakout is likely to fail, probably buyers below. Sellers above, maybe for a small second leg, but that second leg could be very minor before we bounce. We triggered the buy above 22, which again was an inside bar, so reduces the probability for breakouts. We broke out but did not close above, and now 23 is a low 1 signal bar, but it's a bull bar, low 1 at the bottom of a trading range. There's buyers below 23. And then 24 rallied, traders bought the close, and you see that all the time. And I think I mentioned that. I know I mentioned it recently. You see it all the time where you get a low 1 at the bottom of a trading range. Traders will buy below, but they don't get the chance. And the fact is, no institution was willing to sell below 23. That's why we did not go there. Instead, we rallied on 24, and the bar opened on its low. So it's a sign of urgency. This is a minor leg 1, but it could turn into a major leg 1. 25, surprise bar. So bears sold a close. We had a tight channel, a pullback, still below the moving average, and then a big bear bar 25. But what did I say about the expectation? I said we're expecting a test of the channel, the start of the channel, spike, pullback, channel. So this bear breakout is actually low probability. Plus, we haven't broken out of the trading range yet. If bar 78, the low of 78 is the trading range, we tried to break out but did not close below. Even if we do, we have to worry about these prices over here. There's a lot of trading range price action, and we're getting a lot of sell climaxes, and that is unsustainable behavior for the bears. 25 looks like it's the biggest bar in the sell-off. This bar is about 12 points. This one's 15, so bar 25 is the biggest bear bar in the entire bear leg. And for a couple of reasons, the fact that it's consecutive sell climaxes, the overall context, this looks like a bear leg in a trading range. Then you get 25, the biggest, most climactic bar in the sell-off after about 20 bars. This looks more like an exhaustion gap than a measuring gap. So 25 is a bar that bulls will actually buy the close of. Bears will also buy the close, betting we're low in the range. They'll just take profits. It's a big bar, and they'll take it as a gift. So that's what happened on 26. Bears got no follow-through. The context was bad. Now we have an inside bull bar closing near its high on 26. It's a bad stop order signal bar for the bears, so buyers below. Bulls can buy above because the context supports it, but the inside bar reduces the probability. However, I would not sell above this bar. 27, successful bull breakout of the bar, closed above. Now 27 is a low 1. You can call it a low 2. 24 low 1, 27 low 2. But we did break to a new low, so it doesn't matter what you call it. The point is it's a stop order sell with consecutive bull bars at the bottom of a trading range. So probably buyers below 27. Just like here, this is now a minor leg 1, but it could convert into a major leg 1. And then 28, that's exactly what happened. We rallied straight through that resistance, so it doesn't look like there are sellers there. We closed above it. And now this is a major leg 1 breakout for the bulls. Wedge bottom, wedge double bottom, close far above the moving average. Even if you wanted to go for a measured move of bar 28, you can see that measured move target is still within the trading range. It's not like you're going for, this is a little less reasonable. Maybe you go for the entire 3-bar bull spike, and it's still not that unreasonable. You're going for still below yesterday's high, the close of 48. It's reasonable. But the point I'm making with 28 is it's probably more likely we're going for a measured move up before we come back below this bar. The context supports it. The momentum is good. 28 is a buy the close bar and buy a pullback. Basically the opposite of this. You could sell the close of 9, sell a pullback. Here, you can buy the close, 28, buy a pullback. Pause bar, 29. Think about if you're a bear. If you sold anywhere for any reason, even if you sold above bar 25, 28 trapped you. And then you get a pause bar. And you're wondering, am I going to get a chance to get out down here? Maybe this breakout point? It's not very clear. The fact that 29 is just a pause bar. It wasn't a bar like 16, a strong bear bar pulling back. That's a little nerve-wracking for the bears who are trapped. Plus you have bulls who did not buy. They're wondering, is this all the pullback we're going to get? Do I just buy below the bar? That's why dojis are considered the minimum follow-through. Because it would have been better if 29 rallied, closed up here somewhere. But just the fact that it's a doji and not a bear bar is good for the bulls in this context. And then 30, traders bought the close of the bar. So we're rallying a little bit higher. We're going to keep an eye on the measured move target of, we'll start with bar 28. And what's interesting about that is it looks like it's the low of bar 7. It's close. So you can see bulls who bought here disappointed with the sell-off, but it's a trading range, so if they don't panic, they scale in lower. They'll probably avoid a loss, which at this point they already did. They would have. Let's actually go over that too, because that might be where bar 29 rallied to. So let's say a bull bought below bar 7, and it's reasonable. You can argue it's consecutive bull bars. You expect a small second leg, but then they get trapped. Let's say they don't exit and they hold all the way down. And they buy above this bull bar, consecutive sell climaxes, exhaustive sell climax. Let's say they buy above bar 26. If you bought here and bought more lower, your average price is the midpoint between the two entries, which is the red line I'm drawing now. And look at that. So what happened? Bulls bought, disappointed, but it's a trading range. They can buy lower, and there's an 80% chance they can avoid a loss. How do you avoid a loss? If you buy here and buy here, then you exit the entire position here. And that's where we rallied to on 28. Now there's a 60% chance you can, 80% chance you will avoid a loss, 60% chance you can make money. So if the bulls hold, we'll probably get a test of that bad signal bar. I also forgot to mention this earlier, but if the market's in a trading range, gaps tend to close. When the market's trending, you don't get gaps that close. But because this looks like an overall trading range, just like over here, 48 low, there was a gap from the 48 low, or the open of 48 to 56. Pretty big gap. But if you held, you would have had a chance to exit during bar 7. So 30, we're rallying, and we have a buy climax, a pause, buy climax, a little smaller, but we might pause again. But because it's less climactic, we could just continue here to the top of the range. As far as day structure at this point, we sold off on 1, went below it, we rallied up to bar 7, went above, went to a new low. We might go to a new high. This could be an expanding triangle day. 31, follow through buying, good for the bulls. The spike is growing. However, the spike in this context, you're not necessarily buying here, buying the close, betting on a breakout and a measured move all the way up here, because the context does not support that. This is probably a buy vacuum test of resistance, like this red line, maybe the new high of the day, maybe yesterday's high. That's why I mentioned just a measured move of bar 28 was reasonable, because it wouldn't require a breakout of the trading range. You can see that's that line there. And that was reached on 32. So we're rallying further. This is a micro channel. There's been no pullbacks since here. So the odds are there's buyers below. This is a strong enough rally for buyers below and a second leg. The context is getting worse because if you're buying up here, you're now buying fairly high in the range. But the momentum's good enough, and it's just one leg, that you can get away with buying below a bar, scaling in if you have to, and then exiting on a retest of the highs. 33 going even higher. So we broke out above the low of 7. Maybe we'll test the close. Maybe we'll get to a new high of the day. It does not look like the bears are selling yet. But once we get to a magnet, that magnet can turn off immediately. And so, for example, what I mean by that is we could test the prior high of the day, the bar 7 high, that's a magnet, and then just suddenly reverse down. It's less likely here because of the strength, the momentum, and the characteristic of this bull spike. The bars here are uniform in size. It's pretty controlled buying. The bulls are controlling price and time. So probably not going to reverse straight down. The bears probably need at least a double top or a micro double top. So 33, probably going at least a little bit higher, buyers below. And then 34, we have another pause bar. We're approaching the top of the range. We might start finding more sellers above bars, but still nothing for the bears to sell. So as far as getting short here, I would not, even though we're high in the range, better to wait for more reasons to look to sell. When's the last time even limit order bears made money? They really haven't, all through here. So best to wait. 35, we have the first bear bar in, 8 to 10 bars, and it's fairly small, and it's a micro channel, so probably buyers below 35, scaling in lower for a second leg. But it's a bad stop order signal bar, high in the range. There's probably sellers above. 36, we sold off. But still, as long as the bulls who bought up here do not panic, they know this is strong enough for a second leg, we're probably not going to just reverse straight down. This 36, the first decent bear bar after all this, that's a reason for bulls to buy. So bears, if they sold here, maybe they sold above bar 34 or below 35, they see 36, they'll probably take their profits because bears who are selling here are scalping. They're not expecting a bear swing. Bulls buying below bars, expecting a second leg, and again 36 being a bear trend bar after this rally. That's enough reason for bulls to buy. And the bulls did buy. 37 rallied, but then pulled back. Now, if you think about 37, I think this is a pretty interesting concept. Whenever you look at charts, it's almost like you're looking at it's sort of a manifestation of the same thing over and over, just expressed in different ways. And what I mean by that, it's the market cycle over and over. So what we have here, 35, 36, on some small time frame, that's a bear trend. And even if you ignore this, because obviously the context is bad, but 35, 36 is a bear trend. And then 37, the market rallied, pulled back. Even though we only see a tail here, what we know about the tails on bars is that they're trend line breaks. So if we were to look at a smaller time frame chart, which actually might be worth doing, I might go a few more bars ahead and then look back at this. What's interesting here is you have a bear trend, 37, trend line break, and then it sold off. We're getting a retest of the bear trend's low. And so this could be setting up a major trend reversal on a smaller time frame chart. Because on here, on the 5-minute chart, it's unfolding over 3, 4, 5 bars. But on maybe the 100-second chart, it's already 15, 20 bars. So again, I would just want to look at how it plays out, and then we'll look at it on a smaller time frame. But the expectation here, 37, you can argue it's a second reversal. We reversed below 35, rallied above 36, selling off. Now we have a sell reversal bar, 37, high in a trading range, but the context after this rally does not support selling. And you have 37 is a doji bar, not a very strong signal bar to sell below. It's a trading range bar, so you expect buyers below. You might even have buyers on the close of the bar, and that's because of what I was just saying. 35, 36 bear trend line break, retest, and then we possibly get a major trend reversal. And I say major trend reversal in air quotes because, again, it's unfolding over 3, 4 bars. And you can see traders bought the close of 37. So we're rallying on 38, probably going to come back and test the highs. So what's interesting here, even though this was a very strong rally, strong spike, 35 and 36 broke that trend line. And so what do you expect after a trend line? I said it on the weekly chart. I could have said it on the daily chart too, but I said it on the weekly chart coming into the day. Strong rally, trendline break, you expect a retest of the highs. So it's the same thing here. It's all the same logic. Bull trend, trendline break, expect a retest. But this minor reversal, 35.36, it's a minor leg 1. But your expectation is sellers above 35. Disappointed bulls, bears scaling into shorts, high in a trading range. And then same logic here. Bear trend, 35.36, trendline break, expectation is a retest of the lows, and then a reversal. So let me just go a couple more bars, and then we'll look at that. So again, expectation here. Bears don't want to sell below bull bars. Inside bar reduces the probability, probably buyers below, and sellers above, but the sellers may not come in until a distance above the bar, like maybe above 35. 39 rallied, but then pulled back. Now we have a second reversal, 35, and then 39, lower high, double top. But 39 is a doji, and the bulls, they're expecting more of a second leg after this rally, although this could be the second leg because we're high in a trading range, and the bulls may not want to get greedy. We rallied on 37, pulled back, rallied on 39, pulled back. Maybe they get one more push above 35 and find sellers above. But that close of 7, that high of 35, these are resistance areas and reasons to look to sell. Another inside bar, 40. So we're going sideways to up. The bears can see this as a bear flag. We have a bear breakout, and then we have a bull channel. It doesn't look like a bull channel, but on a smaller time frame chart, it's more clearly a bull channel. And you can see it there. Remember, bull channel means bear flag. So bear breakout, we're pulling back, but the rally's weak. We're getting bars with tails above, inside bars, sellers above. We'll probably get the bear breakout. The fact that we're high in the trading range supports that. That doesn't mean we'll get it right here. We still might have to get above bar 35. We may have to get to a new high of the day. It could be an expanding triangle. But in general, here, as far as always in long goes, we're probably no longer always in long. We're either always in short, or you just be flat and look to buy low and sell high. And right now, we're high in the range. So another inside bar, probably sellers above, buyers below, but the sellers may not come in until some distance above 40. We sold off below 40. There were buyers below. We tested the low of 36 and then reversed up. So that's pretty interesting. So again, maybe I'll go a couple more bars and then we'll look at this on a smaller time frame because this area, it's very interesting. You have this 2-bar bear trend, maybe a wedge bear flag, then you get your second leg, a retest. So it kind of is a nested major trend reversal. I'll get into that on the smaller time frame. For now, 41, we rallied. Trading range bar at the top of a small trading range, big bar. Odds are there's sellers above. But again, they may not come in until above 35 or even higher. 42, we triggered the buy, but remember, 1, 2, 3 pushes up. That's 3 pushes to the top of a tight trading range. 42, reasonable to sell for a swing below 42, but you would not put your stop above 42, above 35, or even at the high of the day. Those would be skunk stops. And the reason for that is you're expecting sellers above 42, 35, new high of the day, even above yesterday's high. So as far as stop placement for that trade, maybe you put it at a measured move of this trading range. Maybe some distance like up here, you're safe from a trap if it goes above yesterday's high by a tick or two. So reasonable to sell below 42. However, it could also be a bull flag. We had that strong rally up to bar 34. Strong rally, bull flag. Maybe we get a second leg. Maybe this is all part of the pullback and not the second leg. So that's the danger with selling 42. And then buyers below, 42 on 43. So we're still in this tight trading range. 42 was still a reasonable stop order short. If you took it, you can exit the short, look to sell higher, or you can hold, scale in higher, and use a wide stop. 43, you have bears trapped below 42. We might have to rally a little higher. And again, 35 high is a magnet, as well as the bar 7 close. Inside bar 44, the market's contracting. I just drew that triangle. This is a triangle within a triangle. The market's in breakout mode. 50% chance the first breakout's the wrong way, and then the market reverses. 45, bull breakout, or bull breakout attempt, I should say, because the bar closed below its midpoint, broke out above the prior high of the day, the bar 7 high. Actually, let's double check that. The high is 55.25 over here, 55.25 and a quarter. So it's a one tick breakout, but it failed, closed below its midpoint, closed within the tight trading range. So it's a breakout attempt of a triangle, 50% fail. Might have leg 1, pullback, leg 2, small second leg, which makes sense, high in a trading range. There were sellers above here, and here. So the upside here might be limited. We also have a nested wedge. You can say 3 pushes here, 1, 2, 3, or maybe 1, 2, 3. Bull breakout attempt of a bull channel line, and then a reversal down. So you might have some traders sell to close at 45. And then 46. Looks like there was actually a tick gap. The open of 46 is above the close of 45. So the close is 21 and a quarter. The open 21 and a half. So there was a tick gap. The market rallied one tick after the close of 45 into the open of 46, which is a little surprising to me. But that could be an indication of exhausted bulls and climactic behavior. Why would there be a tick gap to the upside in such context? It doesn't really make sense. 46, bad stop order buy, high in a trading range. The signal bar is better to sell above. And as far as buying below, you're taking a risk. I mean, you can buy below, betting tight trading range, moving average, support, but it's similar. I still think we're on the sell below 42 with a wide stop. It's reasonable to be short here. You're high in the range. 47, we did not trigger the high one above 46, which is so common. It happened down here. This is a low one. Bulls would buy below it, but they never got the chance. Same with here. High one, bears would sell above, didn't get the chance. 47, they'll sell above it if they get the chance. And let me just stop here really quick. We'll look back at this. So right now we're up to 13.25. And I like to look at the 100-second chart. I don't know if that's going to work. It should work. I was having trouble with this the other day too, so worst case, we'll just look at the 1-minute chart. It's weird. Oh, there we go. So what did I say, 13.25? Somewhere around here. And we don't have to get all the way over here. This is the point I wanted to make. So here's that 2-bar bear trend. Let me just pull it up over here, actually. We'll change this daily chart to the day session, 5-minute. I like to be able to see both charts when I'm explaining this. It'll just be easier that way. So I was talking about it up to this point, 35, 36, 37. These 3 bars, we had a small bear trend, a trend line break, a retest. The expectation is buyers. What we're seeing, and what's that up to? 12.35. So that's right here. even on the 100-second, it's a very minor bear trend. But here's a bear trend, deep pullback. So that's obviously a trend line break. The bear trend line, it's kind of silly to draw it. It's pretty extreme, but you can see it's a tight trend line. And then 37, or the bar after 36 here, would break that trend line. But the expectation after a trend line break is a retest of the trend's lows, which we got on this bar. And then you get buyers. And it's nested, so this entire rally becomes a trend line break. This was the bull channel I was also talking about here. Kind of hard to see, but you can see it more clearly that it's a bull channel. So here, bear trend line break with 3 pushes. So 3 pushes up, you expect sellers, expect a retest of the trend's extreme down here, and that's exactly what we got. But now the market's in a trading range. There might be buyers below, and that's what we got. So just pretty interesting. Just quickly flip this back to the daily. And then this back to the 5-minute. So now at this point, consecutive bear bars. And I still think we're on the sell below 42, sellers above 47, tight trading range, possible final flag, which we might have already had the upside breakout of. Remember this inside bar? There was a triangle up to here. Bull trend, but bad context, high in a trading range, triangle, possible final flag. Bull trend or bull breakout attempt, but possible final flag, which means this was the last bull flag. Now we're in a trading range or a bear trend at this point. And let's just also think through one more thing. I had this drawn. Let's say we have the high. We have a test of the highs, which, remember, it's a 1-tick breakout. Bulls who bought the close of bar 7 trapped on 8 and 9. Very disappointed with the sell-off. So then they get this rally. And what do you think bulls who bought here are going to do? They're, of course, going to look to take profits. And then why would are bulls willing to buy up here? Well, we're not really sure. At this point, it's a tight trading range. It might be a bull flag, and then we get the upside breakout of the trading range. But we know that Al's 80% rule means that 80% of breakout attempts fail. We're probably going to stay within the trading range. So more likely, let's put it this way. It's more likely market falls back down to this price than rallies up to here. That's a little extreme. Those prices are kind of far. But I still think it's fair to say, because this is within the trading range. You're expecting bear leg, bull leg, bear leg. So at this point, probably sellers above 47. And again, earlier I said it's not always in long, and it's buy low, sell high. We're high in the range, so it might be always in short. And then 48 would confirm that. 48 to me looks like a give up bar. This also looks like a major leg 1 breakout. Now, I keep saying major, and it's a little misleading, and I want to clarify what I mean by that. Just like over here, bars 8 and 9, I said was a major leg 1 breakout. Up to here, 28, major leg 1. The problem with what I'm saying, it's not technically correct, because when you're in a trading range, everything is minor. Everything is a minor reversal, minor breakout. And so, technically, this is a major leg 1 breakout. But over here, tight trading range, overall trading range. This is still minor. You're not really expecting a big bear trend. However, a measured move is not the craziest thing to expect. And I forget if we looked at that. But you can see the market went for a measured move. And so it's maybe you can call it a big minor breakout or minor reversal. But I don't want to confuse anybody when I say major versus minor. Just like here. For me, it's a strong enough leg 1 that it's probably going to get a second leg, but I'm not expecting a bear trend that breaks below the low of the day and we go for 50 points lower. What I mean by it's a major leg 1 is that any pullback will probably lead to sellers above and a second leg. So what I just drew is the breakout point. This was the bottom of this tight trading range. We're getting a breakout attempt of that trading range. This low, which was support, may become resistance. So these bars are strong enough for a second leg down, okay to sell 48 and then scale in higher. 49 follow through, so bear breakout and follow through, minimum follow through, but 49 is a weak buy setup, probably sellers above. If you're a bull and you see this tight trading range and you think this is getting a second leg, I can buy below, then you get 48, you're probably disappointed with your entry bar, and then you get follow through 49 against you. And so you're looking for any rally to exit your long. Bears, they're also trapped out. They didn't sell. They're betting that the trading range low would hold. All of a sudden, there's a bear breakout and follow through. They're looking for any pullback to sell. And then we got a pullback 50. Looks like a buy vacuum test of resistance. You can see it's testing the moving average and the breakout point. So even though 50 looks like a strong bull bar, it's a micro channel since 45. Context supports a second leg down. 50 is more of a sell to close bar. 51, we rallied a little further, but then reversed down, and 51 became a low one. Pretty strong breakout, expecting a second leg, so reasonable to sell below 51, but 50 might have been strong enough for a second leg. We may have to get a low 2 before continuation. And then 52 may have been that second leg, and that's another thing I could pull up on a lower time frame, or you could do this. It's obviously becoming a longer review here. But bar 50 rallied. It's a good-looking bar, and there might be buyers below the bar, maybe at a 50% pullback. So we pull back 51. But again, just like here and here and here, these are minor leg one breakouts. Again, I don't want to confuse anybody because these are also minor, but these are bigger and stronger. Let's think about it this way. Just compare the two breakouts, bars 8 and 9 versus 10 and 11. Which one is stronger? It's obvious the bear breakout's stronger. Same with here, 12 and 13 versus 14, 15. The bear breakout's bigger, better looking bars, closing on their lows, sellers into the close here. And then, obviously, this bull breakout is stronger than 35, 36. So this is minor. It's all the same logic. Over here, this one is stronger than 50. So probably sellers above in a second leg. But sometimes minor leg ones get second legs, and that's what leads to low 2s, or in this case over here, a high 2. So we have this bear breakout. It's a minor breakout, but it led to a second leg down, 1, 2, and the bulls would have a high 1 over here, high 2, maybe high 3. So what happened on 52? The market rallied, pulled back, rallied again on 52. You can see the tail. And so the tail, 52 rallied, tested the close of 50. But think about if you're a bull and you bought the close of bar 50. You obviously made a mistake. 51, you're disappointed. You'll probably take what you can get and just look to exit the trade. So probably resistance up here. You can see we tried again to get up there and failed, going a little lower, 53. Might be starting the channel phase, spike, pullback, channel. I want to say one more thing because kind of like over here, it's possible we get a measured move over here, but my one concern, I'm not sure I would look for this measured move. I think it's reasonable to go for a measured move of bar 48, but even that, the one concern is the bull breakout. The bull breakout was pretty strong from here. Let's even just go from swing points. This is so strong, there's probably buyers below. Buyers below. If you bought that breakout point, you would have been able to avoid a loss on 51. So I think this 50% pullback level, there's probably buyers at this area for leg 1, pullback, leg 2. This could all be part of that complex pullback. So that's why this is minor. You're expecting a second leg, but you're not expecting to get all the way down here. At least not yet. So let's actually just draw the 50% pullback of that rally. I think that'll be an important price. So just about there. Just label it real quick. Nothing to buy, probably buyers below 49, sellers above. It's a bad high 2 signal bar, and the context still supports lower prices. 54 going sideways on some really small time frame. 51's a spike, 52 pulled back, and these 3 bear bars, they're really dojis, but we're getting lower lows, lower highs. That's a spike in channel over 4 bars. So it would not surprise me if the market bounces, tests the high of bar 52, and then reverses back down. Same logic as I was saying over here, where the start of the channel gets tested. You get a spike, then a channel, and then the channel converts into a trading range. 55, we're breaking out to the downside. Micro channel since 51. 55 is a weak stop order buy, probably sellers above. And if you're buying for a double bottom, you need a very strong entry bar to make up for your bad context and bad signal bar. And then you don't get it. Outside down, 56, probably going lower, the double bottom, unlikely to hold. However, there's the 50% pullback, and that could be support. So as far as holding for a measured move down of the double bottom, maybe here, double bottom, here's the neckline going down here. Less likely because now we have leg 1, leg 2, and look how weak the second leg was. It's a spike in channel, probably going to bounce and get back up here. I'll draw that price too. The high of 52 is the first target. 57 inside bar reduces the probability for breakouts, plus it's consecutive dojis, probably buyers below, sellers above, but the sellers may not come in until up here. 58 we sold off, but you can see the breakout failed. We have 3 consecutive dojis. We tested the 50% pullback, did not get far below it. Might turn out to be support. It can also be a wedge. I apologize, my microphone was muted there. This entire thing could be a wedge bull flag. We had this rally, 3 pushes down, we're testing the 50% level, and we could bounce all the way up here. However, at this point, it's less likely, and really the whole time, this was within this trading range. So you're not expecting this to be a bull trend. But you do expect a second leg after a rally like this. But because it's a trading range, you also expect deep pullbacks, which is what we got. So this is an area, for a couple of reasons, better to maybe look to buy. We could have support. The context supports it, 50% pullback of the bull rally, wedge bottom, and then spike in channel here. Lots of weak bars for the bears. 2 legs down, where the second leg is really weak. The momentum is really fading. We rallied above 58, which was a bad stop order buy signal bar. It's reasonable to buy above that bar for a swing, but your stop does not go below, similar to up here. Just like over here, if you sold below 42 and used a wide stop, you would have been okay. Here, 58, if you buy above, use a wide stop, you'll be okay most of the time. And what's the wide stop there? You could use a measured move of bar 58, for example. Maybe you'll go for a little further than that, but that's usually okay. Now we have a low 1 on 59 in a support area, possible wedge, and 50% pullback, so probably buyers below 59. 60 inside bar, low 1. The fact that it's an inside bar further reduces the probability of a bear breakout. and it's a really small bar, lots of overlap. Buyers below, sellers above. However, increased chance of the upside breakout. Bear breakout attempt, and now we have kind of nested wedges. A couple of ways to see 3 pushes down. And you can see we're reacting to a channel line here. The downside looks limited and lots of two-sided trading. This is on a smaller time frame, more clearly a broad bear channel. And again, the expectation is a test of the start of the channel, which in this case, I have this one, spike, pullback channel. It could be the high of 51. Even though 61 is a doji, it's similar to buying above 58, not the worst buy in the world if you use a wide stop. Inside trend bar 62. However, that could be exhaustion. It's the strongest bear bar since 51, and it's coming late in this channel, low at the channel line, not breaking far below the 50% pullback. It's an inside bar. It's not even breaking out below the prior bar. Inside bars are non-breakout bars. So probably buyers below the bar. Not a good stop order buy. So probably sellers above for a scalp, but as far as selling here for a swing, not ideal. And then 63, a little bit of a surprise. It's a bigger bar. Not quite outside, but almost an outside up bar. 63 is a bad stop order sell. There's buyers below. However, we may not get below. There might be buyers on the close of 63. $64, an inside bar. It's close enough to an IOI. I'm going to clean up the chart a little bit. Close enough to IOI, which just means that's a breakout mode pattern. The market's contracting, expanding, contracting. Breakout below, likely to fail. Breakout above, also likely to fail. However, in this context, probably always in long. We fell below 64, but then failed. And now we have a micro double bottom with a weak signal bar, but the context is good. You can buy above 65 with a wide stop. As far as selling here, not ideal. Probably better to wait for a test of the moving average. Even better to wait for a rally to the top of the channel. This is probably a trading range. And then 66, the bull breakout. Pretty big bar compared to the past few bars. The bulls still want follow through, but the bears still argue. Leg 1, pullback. Leg 2, two-legged pullback in a channel. Bears can sell 66, but if the bulls get follow through, the bears probably have to get out. And then 67, you can see the tail. Traders did sell in the close. We sold off first, but then the bar ended up rallying into the close. We had follow through. Another interesting thing here, 65, even though you can buy above it, it's a trading range bar. It's not a very good signal bar to buy. And so if you got trapped selling above 65 on 66, you can see the tail on 67 gave you a chance to exit at break even. Those prices might be the same. So the high, 502.75, and the low, 502.75. So they're exactly the same price. So if you sold above 66 and then tried to get out at break even, you would have had the chance to. As always, I apologize for the background noise. Rallied a little further above 67 on 68, but then reversed. But it's a reversal bar after a big enough bull breakout for a second leg. We could get a deep pullback, but selling here is not ideal. You're expecting buyers below, and we're probably going to rally at least a little bit higher. 69, inside bar. It's a high 1. There might be buyers above for a scalp for a second leg. However, selling below, not ideal. Again, not an ideal place to sell. After this bull breakout, the overall context, we're expecting higher prices. Now, if we get a third push, 1, 2, 3, then the bears might look to sell up here. 70, we sold off, but it was a bad stop order sell, so there were traders buying below. The breakout failed. 70 is a bad stop order buy signal bar, but it's a micro double bottom, high 2. After a bull breakout, it might go a little higher, but there's probably sellers above 68 and sellers at the 51 high. 71, we're rallying, lots of overlap, past 5 bars, tight trading range, so the upside might be limited. We might be creating a wedge. Inside bar 72, sellers above, buyers below, but the sellers may not come in until a distance above. 73, bull bar, closing on its high, breaking out, but it's a minor breakout. At this point, we have maybe a nested wedge. So 1, 2, maybe we get a third push, 3, testing the channel and this channel line. And then here, 69 rallied, pulled back, 72 or 71 rallied, we paused, maybe a third push. And then we're getting it on 72. But 72, or 74 rather, 74 is a good looking bull bar, but it's a little climactic. And again, 3 pushes up. So this is an area where the market might be getting vacuumed into resistance. And then there's sellers above, nested wedge, 1, 2, 3. And I just pointed this one out. 1, 2, 3. 75, we went a little bit higher. We're testing the start of the channel. Should have mentioned 74 didn't quite get there. So we're probably going at least a little bit higher. And then we did on 75. But now 75, small follow through for 74. But still a nested wedge. The context supports probably taking profits here if you're long, and it's okay to look to short. However, there's no stop order sell, but this looks like an overall trading range. Big down, big up. Sideways 76, going more sideways here. The market's likely in a tight trading range. But at this point, we're testing the start of the channel. A couple of legs up, maybe 3 pushes up. And so the expectation is a reversal and a test lower in the range. And then we got a bear breakout 77, but it's a minor breakout. The market's in a trading range. So it's a bear breakout, but look to the left. Lots of overlapping bars, not reversing very much. You're expecting bad follow through. 78, we went a little lower. We're testing the bottom of the range, but we didn't quite get there. So there's no breakout below the trading range. And so this looks strong, looks like good momentum, but it could easily be a vacuum test of support. Inside bar 79, but it's a low one at the bottom of a trading range, probably buyers below, even though it's a micro channel for the bears. Context, not good to sell. Inside bar 80, consecutive inside bars, breakout mode, but just 1 bar to go in the day. Buyers below, sellers above, and then we went outside up 81. Always in today, we had trading range coming into the day. Big down, big up. And so when that's the case, the market's rallying, but you have 3 pushes up to the top of the range. Context says it's always in short because we want to buy low and sell high. So it's probably always in short up here, and then you confirm it with 8 and 9, probably going lower, and still always in short. But at some point, this becomes a channel at the bottom of a trading range. So somewhere in here, this could already be always in long. And then that switches the always in, confirms it, always in long, until we get back to near the top of the range. And so here, it looks so bullish, and you're getting to the top of the range, it could already be always in short. And then after that breakout, you're not expecting that to lead to a big bear trend, but you are expecting sellers above. So maybe a little higher, but then always in short up here. That confirms it, probably going lower. But then again, this was really weak. This was a broad channel on a lower time frame, and then a test of the 50% level. So in here, this might be always in long. And we bounced, but then we're testing the 51 high, the start of the channel. So here, probably always in short. So it's kind of backwards. It's kind of counterintuitive. I learned this from Brad. He said, always in trading ranges is you gotta have to treat it like it's opposite day. And just something to pair with that. Always keep in mind for trading ranges, you want to buy low and sell high. And what's tricky, the reason why it kind of looks backwards is because the market looks like it has strong breakouts when you're at the extremes of the trading range. So like up here, good bull bar 6, follow through 7. but you're high in the range. It's probably a buy vacuum testing resistance at the top of the range. And then here, you're not clearly at the bottom of the range. The bottom of the range could be way down here. That's why it's not ideal to look to buy this sell climax. And the terminology, technically, as Al teaches, all breakouts are gaps and climaxes. But you would probably call this a breakout, and you'd probably call that a climax. But that's the logic of down here. This is a exhaustive sell climax. You wouldn't call this a bear breakout. So this is one you'd rather look to buy, because even though it looks like a bear breakout, you're at the bottom of a range. Bull breakout, but you're not clearly at the top of the range. So bull breakout, not a climax, probably going to go higher. Then up here, getting higher in the range, so probably look to take profits soon. Bear bar, closing below its midpoint, you can get out below. Same logic here. Bear breakout, not clearly at the bottom of the range, probably going lower. But then so much two-sided trading, 3 pushes down, a couple of ways to look at it, 50% pullback. Kind of getting off topic. For stop orders today, I thought it was reasonable to sell below bar 8, sell below 9, sell below 12, low 1. Sell below 16, expecting lower prices, maybe a test of the bottom of the range. And then 26, it's aggressive, but you can buy. And then you can buy above 27, 28. You can buy above any of these bars, but somewhere in here doesn't really become worth it to buy anymore. Would have been better to buy lower, look to take profits up here. As far as in here, stop orders, not really ideal. I did mention 42. When you're taking stop orders in a tight trading range like this, you usually get chewed up. And so if you do take the short below 42, you want to use a wide stop. And then you could sell below 47. You could sell below 48, 51. It's a low one, kind of similar to 12 over here. You're expecting a second leg down after this breakout. Over here, stop order buys. I didn't think it was crazy if you bought above 58 or 61, which didn't trigger, or even 65. The context was becoming better to buy. 66 bull bar closing near its high, and you're probably going higher. You're not at the top of the range, so reasonable to buy above 66. And then there wasn't a great stop order up here, but you did know that if you're testing the 51 high, you're probably high in a trading range, so reasonable to get short below 75 or 76. And then for limit orders today, strong enough rally on the gap up, probably buyers below bar 1. And then this is a higher high double top, bar 4, but the signal bar is weak, buyers below. Bar 5, probably sellers above, and if you sold above and scaled in, you would have made money. I didn't think 7 was a good limit order buy because of the context. You're high in the range after 3 pushes up. Bar 10, you could sell above, betting it's a minor reversal. So this is a more major breakout. You bet on the reversal failing, so you can sell above bar 10. And I think it's always in short. So as far as buying below 11 or 10, not really ideal. Better to look to sell. So same with 14, probably a minor reversal. You could sell above it. Not really ideal. It's a bull bar closing near its high. Better to sell above a bar like 15. And then through here, you could sell above 17. Obviously a weak stop order, tight bear channel. And you could even sell above 22, inside bar, tight channel, but selling here, more risky. You're at the bottom of the range, not ideal. This bar's maybe 21 through 24. That's a micro channel, and it's low in the range, and it's enough of a minor reversal. There's probably buyers below 21, and they would have got triggered on 25. Micro channel all the way up. So by the time you're able to buy a pullback below 34, look where you are, the top of the trading range. So not really ideal to buy below here. However, buying below 32 or 33, that's the better buy. And you can see you actually would have gotten triggered below 32. And then I thought sellers above 35, that wouldn't happen until all the way over here. And all through here, you can basically buy below any bar, sell above any bar. and make money in this tight trading range. Strong enough breakout for a second leg, sellers above 49, and then micro channel, sellers above the first pullback here. But now we're getting maybe two or three legs down, low one at the 50% level. Better look to start buying below bars here. So I thought buying below 60 was reasonable. Buying below this bear bar was reasonable. Didn't trigger. Buyers below any of these bars, or even on the close of 62, disappointed bears who sold, disappointed with 63. You can buy when they get retested. And then bull breakout. Buyers below the first pullback. Bad short below 68. You could buy below. Didn't trigger. Inside bar, you could buy below 69. And then eventually here, you get to the top of the range. So you could sell above 51. And I thought selling above 51 was reasonable because I mentioned this earlier, the nested wedge. So as far as getting triggered above 51, you had a limit order there. Thought it was really reasonable. 1, 2, 3, 1, 2, 3. Top of the channel. Spike in channel, expect a trading range, and then resistance here. And then I mentioned you could buy below 79, but that didn't trigger. And then buyers below here, but not really worth it at the end of the day. And so for the day type today was a pretty standard trading range day. It was mostly horizontal, and it wasn't quite an expanding triangle, although it kind of looked like it may be one. We didn't end up going to a new high over here. Or we did, huh? So we rallied, sold off to a new low, rallied to a new high, but didn't get to a new low. And so you could call it an expanding triangle. The shape isn't great, but overall I would just call this a trading range day. You could even call it a contracting triangle where the range got smaller, but also not the greatest shape. But overall, mostly just horizontal, sideways trading range price action today. And then where do we go tomorrow? Let's look at the daily chart. We have a low one short after 2 legs down, consecutive bull bars. And I still think we need a retest. So if I draw the tight channel here on the daily chart, sure enough, the bulls had this strong, tight bull channel, but then the bears got this trend line break. So I think we need to retest the bull trend's extreme, whether it's the trend line here, maybe a new high, but somewhere up here. So here it's a low one, but 2 legs down, and there's probably buyers below today's low. If we get to Thursday's close, probably buyers at that price as well. And then sellers above, probably sellers at the moving average. This bar closed below its midpoint. It's a bad stop order buy. As always, please feel free to leave questions in the comments and include timestamps for any questions specific to this video. All right, hope everyone has a good rest of their night. Thanks for watching.